So after your market experts, my job is to put you to sleep as a regulator. But first of all, I wanted to thank Outlook Money. You know, one of the pillars of the mandate for Sebi, Securities Exchange, is actually investor awareness and investor education. So a program like this, which is hopefully becoming an annual feature, is of huge importance towards investor education and investor awareness, particularly as we see more and more savers becoming investors over time. I know it's an eclectic crowd. You have traders, you have intermediaries, you have investors. But what I thought I'll cover today is, I was given the topic of risk versus return and the connect between the two. Today is probably a fantastic day to talk about risk and return. If you saw the headlines both yesterday in the TV as well as today morning, it was all about the bloodbath on Dalal Street, how things are looking terrible, what the hell is happening, why are FIs going away. It's important, though, to put things in a little bit of perspective. So today, just before I came up on stage, I understand the Nifty is around 25,400, give or take. Who knows where it'll end. March 2024, which is a few months away, six months ago, it was 22,300, which means markets are actually up by more than 13% year to date in this fiscal year alone. Last year, October this time, since the Nifty was around 19,400, which means markets are up by more than 29% since then. March of last year, 2023, it was 17,400. Again, a substantial jump since then. March of 2020, you remember those terrible times during the midst of COVID? It was 8,900 or so? Again, more than almost 3 times growth since then, right? 5 years ago, the Nifty before COVID was about 11,300. Today, Nifty is more than twice that. The compounded annual growth rate over the last 5 years for Indian markets has been more than 17% per annum. It's the best performing market across all major markets in the world. We are suddenly talking about China and Hong Kong and all that. Do you know that China is barely up 3% compounded annual growth rate over the last 5 years? Hang Seng, Hong Kong, despite the big moves in the last few days, is actually negative over the last 5 years. It's still a down market. Hopefully it'll change, but it's still a down market. So doesn't it seem a little incongruous that at a time when we've had this fantastic performance, we're actually talking about, oh my God, what the hell is happening in India? And why are FIIs going away? My submission to you is, it's actually not incongruous. Because we tend to mix up two very, very different things. One is the return, and the other is the risk. Return is a point-to-point measurement of where we were and where we got to. Risk tells you how the journey was, how bumpy it was, how smooth it was, what did you feel like during that journey. Now, often as advisors or as investors, we are advised, don't worry about the journey, worry about the return. After all, markets are growing over a period of time. Why on earth are you worried about risk? I don't think that's very good advice. The reality is, we all have our risk appetite. It's not just the end-to-end which is important, it's also the journey that's important. So while we have done a great job in the market of describing what is a return, I don't think we have done adequate work on describing the risk involved or the quality of the journey as we go from point to point. And this is a journey that we have to traverse, particularly as more and more Indians come into becoming investors. So how do we actually measure risk? How do we measure the bumpiness of a ride? And this is where things get a little tricky. The most ubiquitous measure is actually something called volatility. And it becomes mathematical, so it gets a little confusing for the average investor. But volatility is trying to tell you how much does the daily returns vary by. So if on one day markets are up by 2%, the next day it's down by 2%, third day it's up by 5%, down by 2%, that variation in the returns is one measure of risk. How bumpy do you feel? That volatility measure actually also figures in our futures and options market, particularly in our options market, which I'll come to in a bit. If I look at the volatility of Nifty since April of this year, so for this fiscal year, it's still about 16%. Those of you who are familiar with volatility will know that. It's about 16%, which is not too much. While we are complaining about yesterday and day before yesterday, actually 16% is reasonably good volatility for an equity market. If I look at the last 5 years, it's been about 17%. And remember, over the last 5 years, we had COVID, we had the Ukraine war that Shankar spoke about. We had a lot of things happening in between. So 17% is quite decent. Incidentally, this is the volatility of Nifty as an index. If you choose a single stock, including Nifty component stocks, the volatility will be significantly higher. It will range between at least 20 to 35%. So imagine if you're feeling antsy about 16%, how would you feel if you're actually sitting with 35% risk? Some mid-cap, small-cap stocks, even 50%. Including NASDAQ stocks, some of them are 75%, 90%. So somehow we've got to try and internalize this meaning of volatility and learn to look at both the return as well as the risk or volatility together. As an investing public, we have not yet done this adequately. In Sebi, we've got something called the riskometer, which we use for mutual funds. I think it's a very poor substitute for actual volatility or actual metrics for risk. So the first pitch I want to make to you is risk and return are two very, very different things. Return is point to point, how much have you moved? Risk is how bumpy was your journey. And both are important. Do not de-emphasize one over the other. Both are equally important. How much appetite you have for risk is only something you as an individual can answer. Nobody can answer it for you. I come from a lower middle class family. My father made the transition from poverty to middle class and gave me an education which he couldn't afford for himself. I have seen bad days, so I cannot handle risk. My risk appetite is very, very low. If I see my wealth coming down sharply, by the way, you saw a very sharp decline in your wealth in the month of March 2020. That's part of volatility. Of course, markets came back and in fact did extremely well after that. But to be able to sit through that volatility and see your value decline is not something everybody can stomach. So the answer about how much risk can you take is yours to answer alone. Nobody can answer it for you. Is it 15%? Is it 20%? Is it 25%? That is something that you have to internalize. And those of you who are dealing with investors, please help them, educate them on this measure of volatility. And please help them gauge what is their appetite for risk. It's extremely important. Now, a few things about volatility. Last year, FY24, which is April 2023 to March 2024, was a brilliant year for Indian markets. The volatility of Nifty was just 10%. 10%, I can tell you, is extremely low. It comes down towards, fixed income kind of category in terms of volatility, right? And the return was over 28%. We had a phenomenal growth during that period, which continues even now, by the way, despite the aberrations you're seeing the last few days. In a sense, this is not good news, because when you have this very beautiful combination of low risk and high returns, that spawns complacency. And here are some numbers which, as Sebi, we sometimes get worried about. In March 2020, there were 2.2 crore unique mutual fund investors. Today, we have got nearly 5 crore unique investors. It's 4.9 crores right now. We had 4.2 crore unique demat account holders as of March 2020. Today, it's nearly 11 crore unique demat account holders. A lot of the people who have come in over the last 3-4 years are young. They're below the age of 30. In fact, nearly 70%, 75% of those trading in F&O were actually below the age of 30. Many of them have not seen down cycles at all. So if you come in expecting that it's all a beautiful, lovely game where you can become billionaires overnight by trading in markets, that's actually setting up for a lot of trouble going forward. I want to throw some more numbers at you on this one. During fiscal year 23, which is April 22 to March 2023, the total money that came into our capital markets, equity markets, through mutual funds, through FPIs, through insurance companies, and through individuals, was about 1.8 lakh crores. As opposed to that, we had supply, which is fresh IPOs, FPOs, QIPs, and all of that coming in, of about 1.6 lakh crores. So the demand and supply was largely matched in FY23. Fast forward to FY24, the demand for paper from individuals, mutual funds, FPIs, insurance companies, pension funds, doubled to 3.6 lakh crores. The supply of fresh paper was less than 2 lakh crores. It was just 1.95 lakh crores, which means the difference between the supply and demand for paper was 1.65 lakh crores. It's again a reflection of this complacency that everybody wants to participate in this market. One of the reasons why markets have done so brilliantly is exactly this. We are seeing more demand than supply of fresh paper. So you don't know how much of this is actually translating to capital formation and how much of this is just reflecting into asset inflation, where the prices are going up simply because there's more demand. Now, things will stabilize. We are getting more IPOs. We are seeing some large bumper IPOs coming in. But my point is, one has to be very, very careful about not becoming complacent. In a sense, the volatility we are seeing over the last couple of days is actually not bad. Giving everybody a sense of the risks involved will ensure that people come in with their eyes open, that people understand the risks, and become sensible and good sustained investors, rather than simply chasing a dream and trying to do too many things. So that's my second message. First is, risk metrics is as important as returns. Second is, important to figure out what your risk appetite is, and by the way, avoid complacency. Over the last few months and years, we have seen signs of some complacency building up. To that extent, some volatility is not bad. It will give everybody a reality check. Now, the third element is, particularly for retirement planning, and many of you are experts, so I don't need to tell you this. Here are some very simple rules that people can follow when it comes to building an investment corpus and trying to get the best bang for the buck. You know, Harry Markowitz, who's the author or the father of modern portfolio theory, way back in the 1950s, said that the closest thing to a free lunch is diversification. And this is the beauty of diversification. I talked to you about various volatility of various products. I told you that individual stocks have volatility of 20 to 35% in Nifty. Put together, the Nifty volatility is 16 or 15%. And that's because of diversification. So here is the beauty of diversification. If your risk appetite is 20%, your maximum return will never come from holding one asset class with volatility of 20%. Your maximum return will come if you have a portfolio of diversified assets which has a risk return of 20% or a risk of 20%, but the return will be far higher than that one single asset which had 20% volatility. In other words, for a given risk appetite, you have to diversify if you want to maximize your returns on a sustainable basis. That's the first way of looking at this. The second is, if my return expectation or return ask is so much, picking one stock or one asset class to get that return is almost always foolish. Because if you diversify all your asset classes, the risk for getting that return can be minimized. So diversification is a huge, huge, huge positive for retirement planning. It's a simple lesson which we have to learn. And by the way, we often talk of diversification only within one asset class of equities. That's not the way it works. Diversification is across equities, across fixed income, across commodities, across gold, across real estate, across currencies, across a whole bunch of asset classes, not just the one that your distributor is selling to you. And it's important to have that portfolio built correctly. Couple of other lessons which come along with diversification. Here is something which has almost always been proven by research. The more you trade, the less you make. There is ample research which shows this. There are some people who are good traders, don't get me wrong. They will make money, and more power to them. But for most normal human beings, because there is transaction costs, STT, brokerage, exchange charges, etc., involved, the more you trade, the less you make. And I'll talk a little bit about futures and options, where Sebi has taken some action recently. That was a pure reflection of this maxim, that the more you trade, the less you make. You've seen our research which said that over the last 3 years, 93% of individuals actually lost money. And cumulatively, over 3 years, including transaction cost, they lost 1.81 lakh crores. And 75% of people who had lost money for 2 years in a row continued trading in the third year, because it's an actual addiction. But the reality is, the more you trade as an individual, the less you make. Second, as I mentioned to you, building asset allocation is the most important decision you will make in your financial planning. There's a nice paper by Brinson, Bauer, and B. Bauer and Hood, I think in the late 80s or early 90s, which basically showed that the difference in return across different portfolios, 93% of it is simply explained by different asset allocation. Things like choice of security or timing the market, aaj niche khareed lo, kal upare bech do, all that kind of stuff, at best accounts for a 3, 4, 5% of the difference in the returns. So in practical terms, being able to time the market, choose the stock, and research shows, I'm not giving you my personal view, research shows that practically that doesn't work. What matters is choosing an asset allocation and then maintaining that asset allocation over a period of time. You do have to rebalance your asset allocation. So for instance, if you say 60% equity, 40% debt, very simplistic. If equity markets do well in a year, your portfolio will no longer be 60-40. It might become 70-30 because the value of your equity has gone up. Then you have to rebalance your portfolio to bring it back to 60-40. That's when diversification works. So you do have to, manage your portfolio, but the idea is to maintain that asset allocation rather than doing active trading. Now, again, don't get me wrong. Some people like the thrill of going on a roller coaster. Some people like to trade. It's your hard-earned money. Do what you have to do. But just be aware of the odds and be aware of what makes you sustain money. And by the way, as a normal human being, if you're spending inordinate amount of time watching where Nifty is, then you probably are doing something wrong. You need to be able to see it once in a while, not really on an ongoing basis. Now, I want to talk a little bit on this, on the steps that Sebi took on futures and options. We announced a few steps, I think a couple of days back. Just to clarify, we are not for a minute saying we don't like futures and options. There has been some reports saying Sebi is against derivatives. Not at all. In fact, I can tell you as a member of Sebi that we want futures and options. And the reason for that is derivatives help in price discovery, derivatives give you market depth, and derivatives actually helps the overall ecosystem by, in a sense, even reducing volatility and giving people the ability to hedge their risks. So we are not against F&O at all. We are not even against speculation. Unless you have speculators in the market, you will not see a robust market ecosystem with liquidity. So as a regulator, I'm telling you, we are not against speculation. We are not against derivative markets. So what is our problem? The specific problem that we saw was in respect of trading in index options on expiry day. So those of you who are familiar with F&O, futures and options, As your expiry day comes closer, the value of the option naturally reduces because the time to expiry is reducing. So on the day of the expiry, it can come down to as low as 100 rupees per contract or even less than that, 25 rupees per contract. So what we saw was, on the day of expiry, and you had an expiry every day of the week, right? Different expiries on different days of the week. On the day of the expiry, we saw 95% of the trades of some contracts going through only on the last day, where people were buying and selling in 3 minutes. Buy in 3 minutes, sell it off in 3 minutes, again buy in 3 minutes, sell it off in 3 minutes, for really small premium. They were buying, for 2,000 rupees, selling it off at 1,500, buying again at 1,200. So it was really a churn happening for tiny amounts and tiny risks for almost like a slot machine in a casino, that you keep putting in coins and you're hoping for a jackpot to be hit. Now, I'm not saying all of FNO is a casino, not at all. Single stock FNO is good, futures is good, even options and indices is good prior to the expiry day. All of that is absolutely fine. But on expiry day, this frenzied over trading that we saw didn't really make any sense. To argue that somehow it's aiding capital formation was very, very difficult to understand. How is that possible? We are very, very conscious as a regulator that we should not throw out the baby with the bathwater. In that last 2-3 hours of trading in index options, we couldn't see any baby in the bathwater. We could only see bathwater. So the steps that we have taken are very, very focused on trying to reduce this over trading in index options on expiry day. That's all. To say that we are becoming Korea and trying to clamp down on FNO, that is absolute rubbish. In fact, we have taken steps to increase the number of stocks on which single stocks, futures, and options can trade. We've actually taken steps including reducing transaction charges for increasing FNO volumes outside of this index options on expiry day. So, as I said, we like FNO, we need speculators, but not this frenzy that we used to see on the last day. That was resulting in a lot of investor losses, like the numbers I told you, and that was creating systemic risk. And that's the only thing that we have tried to address. Coming back to this point about risk and return, so risk is extremely important. We have not managed to box the measurement of risk adequately. Each person has an individual appetite. Creating a portfolio, running with that portfolio on an asset allocated basis, best way to maximize your returns. The final point I want to make is the importance of choosing a good financial planner in your journey for retirement. We as Indians don't like paying for anything, particularly for advice. So when you ask an advisor, why don't you do more of advisory? They say, boss, Indians don't pay, right? We don't mind paying a doctor for medical advice. We don't mind paying a chartered accountant for our tax returns. We don't mind paying a lawyer for legal advice. But financial advice, free mein chahiye. So we do go to people who don't charge us overtly. So we go to mutual fund distributors. We go to LIC agents, where we can't see what charges are being levied. But of course, charges are being levied indirectly because the producer is paying them. Mutual funds are paying the distributors. Insurance companies are paying the agents, right? So that we are okay with, or that we are oblivious to. But somehow we don't want to pay for actual advice. Here is a challenge that we have as Sebi. We need people to guide investors on their investment journey. Some of you are excellent investors. You don't need investors guidance, that's fine. But the majority of the population requires good quality advice. We've got to make sure the advice is aligned with the investor interest. Which means the advice being given should not be based on the product that's giving the highest commission. It should be based on what is the appropriate asset allocation for that individual, for his or her risk appetite. Not that on this product I'm getting more commission than the other one, so I will sell that. And this is a challenge that we have to manage. You must have seen in our recent board meeting we've actually come out with easier regulations for investment advisors and research analysts. We genuinely want that community to grow. Because if there is one community whose interests are always going to be aligned with that of the investor, it's actually the investment advisor, because they are not supposed to get paid by the producer. They only get paid by the investor per se. So I'm going to stop here. Thank you very much once again to Outlook Money for taking this trouble, for putting this conclave together. We are moving on the journey towards financial inclusion, moving savers to becoming investors. I fear that there is a bit of complacency which is kind of setting into the ecosystem. To that extent, a bit of volatility is not bad. It actually brings a dose of reality so that people understand the risks better. There can be no doubt that long-term, the story is really strong and will hopefully continue to remain strong. There is also no doubt that our capital markets have to do well for India to achieve her enormous growth potential. At the same time, it's important that investors come in with their eyes open, that they do not come in expecting to become billionaires overnight and therefore take on inordinate amount of risk. That can give us a shock which we can do without. So people like Outlook Money who are doing more to spread the cause of investor education and awareness, more power to you. Please keep going. Thank you so much.